And good morning once again, options traders. Welcome back, everyone. Well, this presentation comes from a question that was written in from one of our traders asking how do compounding periods affect returns? And the question was specifically about dividend reinvestment plans, also called a DRIP. And the question was, does it really make a difference if it pays, let's say, quarterly versus monthly? That's a really good question. So let's go find out what is compounding all about and how do the compounding periods affect the returns. As always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So let's start off with really the two basic ways that, let's say, a bank could pay interest. One is called simple interest and one is called compound interest. Now, you don't see much that is paid in terms of simple interest these days, but if you do, this is what it means. Let's say that in both cases the bank pays 10% interest. I'm just doing that to make the math a little easier. You deposit 1,000 bucks. At the end of the year, the bank pays you 10% on that 1,000 for a total of 1,100 bucks. So you pick up 100 bucks after the first year. But now here's the catch under simple interest. The bank only pays the interest on the initial deposit. So if you leave it in there for a second year, the bank only pays 100 bucks for a total of 1,200. It's not paying you interest on interest. It's not paying you 10% on that $100 worth of interest. And then finally, let's say after the third year, it's only going to pay 100 bucks. Down here from year 9 to year 10, only 100 bucks. It's just paying the interest rate based on the initial deposit. So it's as if the bank is saying, hey, if you want to leave this interest in the bank, that's up to you, but we're only paying you interest on the principal. Now, again, this is not seen a lot these days, but if you do see something that advertises simple interest, this is the way it's calculated. Compound interest, on the other hand, does pay interest on interest. So let's look at that same scenario here under compound interest. You deposit 1,000 bucks. At the end of the year, you've got 1,100, just like you did under simple interest. But in the second to the third year, you're going to make 10% on 1,100. You're making 10% on the 1,000 plus 10% on the $100 worth of interest. And that's going to give you a total of 110 bucks. After the third year, you're going to make 10% on 1,210, and that's going to give you an additional $121. So we can see it starting to grow. Down here from year 9 to year 10, now you're picking up 236 bucks. So you can see that in the early stages, there's not a big difference between simple and compound interest, but in the later stages, that's where it really picks up. So it's kind of a tricky process to follow. Here's what it looks like graphically just to show you how complex it can get. Let's say here's your initial $1,000. At the end of the year, bank pays you 100 bucks. And it's just going to sit there and there forever. But after 2 years, what happens? Now the bank pays you 10% on the 1,000 for 100 bucks, but they also pay you 10% on this 100 for a total of 10. So there's the $110 in year 2. In year 3, it's going to get even more complicated. The bank's going to pay you 10% on the initial 1,000 for another 100. It's going to pay you 10% on the 100 for another 10, another 10% on this 100 for another 10 bucks, and finally 10% on this 10 for 1. And there is $121 that we saw before. That's where that's coming from in year 3. So you can see that this is going to get out of control very quickly. And this is what it's going to look like over time. So these gray bars are 10% simple interest. That's why it grows at a straight line. But the green plus gray is compounded interest. And the thing to notice, so interestingly, roughly it looks like maybe at year 18, that the interest on interest equals the interest on principal. The green and gray bars are about the same size. But once we go beyond that, look at that, the green bar dwarfs the gray. In other words, the interest on interest is vastly outweighing the interest on principal. And so again, this just shows where that acceleration comes in. It's in the final years where the real benefit comes into play. So here's a good question that will really highlight the power of compounding. Let's say that lilies in a pond double each day. After 30 days, the pond is totally covered. On which day is the pond halfway covered? Now, your gut instinct will probably jump to, say, 15 days, because that's the halfway point. That's not understanding compounding. The answer is 29 days. So think about that. It takes 29 days for the pond to get halfway covered, and then it takes 1 day to match the work of 29 days. So again, it's just to highlight this power of the later years or the later stages when the compounding really kicks in. So that's the basics of compounding. What are compounding periods? Well, the bank could also choose how often it's going to compound. So let's say if you have that $1,000 deposit at 10% interest, and the bank says, well, we compound it annually. What that means is that the interest is paid once at the end of the year. However, a bank might also say it's compounded semi-annually. So if you are earning 10% interest at this bank, compounded semi-annually, what the bank is going to do is it's going to take 10% divided by 2, which is 5%, but they're going to pay that every 6 months. So instead of getting one deposit at the end of the year, you're going to get 2 deposits, one in 6 months and another in another 6 months. And each of those deposits earns interest. If it's compounded quarterly, they're going to take the 10% annual rate divided by 4, which is 2.5%, but they're going to pay that every 3 months. So now all of those deposits will be earning interest for those 4 payment periods. So this is what it's going to look like graphically. If the bank pays semi-annually and you deposit $1,000 today, you're going to get a payment in 6 months, and then you're going to get interest on that balance in another 6 months. If it's compounded quarterly, it's going to look like this. You deposit $1,000, every 3 months you're going to get deposits to your account, which will each earn interest. And finally, if it's compounded quarterly but for 2 years, now there's going to be 8 payment periods. You're going to get one in 3 months, 6 months, 9 months, every 3 months for 2 years. So notice that we now take 4 periods per year times 2 years, which is 8 periods. So this is where we derive this compounding formula. Let's say the $1,000 deposit at 10% compounded annually. You're going to take the $1,000 times 1 plus the interest rate, and then we're going to raise it to the first power, and that comes up to $1,100. If it's compounded quarterly, we take that $1,000 times 1 plus the interest rate divided by 4, or 2.5%, but we're going to raise it to the 4th power because we're going to multiply that each quarter. That's going to give you 1103.81. So you can see not a huge difference, at least for the course of a year. Now, if it's a 2-year investment, the formula would look like this. We take our $1,000 deposit times 1 plus the interest rate, 10%, divided by 4, but there's now 8 payment periods. And so that's going to be 1218.40. So the thing to notice with the compounding, that if the bank is using higher frequencies for compounding periods, in other words, quarterly or monthly or daily, yes, the money hits the account sooner, so the ending balance gets bigger, but there is a limit. And that's because what's called the periodic interest rate is also getting smaller. Now, for anyone who has had finance will certainly know how to figure out that limit. It's what's called continuous compounding. So it's as if the bank is paying every second of the day or every half a second. It just is getting every single possible moment in time, it is paying that interest. So it sounds like you're going to just spiral out of control, but remember that periodic interest is also shrinking towards 0. So we can find a shortcut way. There's this letter called E. It's just a constant used a lot in math, one of the more famous constants. Turns out to be about 2.718. And we can take E raised to the rate, let's say 10% times the amount of time. So at 10%, you can just punch on your calculator E raised to the 0.10 times 1 year, comes up to 1105.17. If it's 10% for 5 years, E raised to the 0.10 times 5 years comes up to 1648.72. And no matter how quickly the bank compounds, you can never beat this number. This is the absolute limit. So notice that when you're working with continuous compounding, or this letter E, we don't have to adjust what's called the periodic interest rate. I don't have to divide this by 4 for quarterly or divide it by 12 for monthly. It kind of comes out in the wash in this formula. It's just E raised to the interest rate, the annualized interest rate, times the number of years. And that will show you the absolute best that could ever happen. Now, a question that a lot of traders have is, does the stock market compound? Well, yes, it does. Let's say you have $1,000 invested in maybe the S&P 500 in the SPY, and it rises 10% at the end of the year. Now, that balance is going to show 1,100. And if it rises 10% again, now you're going to earn 10% on the 1,100. So the stock market does compound, but the question was, what about the dividends? Is it going to make a big difference if these dividends are paid quarterly or monthly or daily or something else? Well, that's where the DRIP plans, again, the dividend reinvestment plans, come in. And the question that this trader had was specifically about monthly versus quarterly. So I'm guessing there might have been two different choices where one compounds monthly and one is quarterly. And the question is it really going to make a big difference? Well, the best way to do that is to put these formulas to work. And let's go over to an Excel spreadsheet and see if it makes a difference. All right, so now we're into our Excel spreadsheet, and I've programmed this to where we can change the interest rate and the deposit. But let's start with $1,000 at 10%. That's the example I've been using. And these columns right here with the 1, 5, 10, and 20 are the amount of years that we're investing. And over here are the different compounding periods. So this would be compounded annually, paid once at the end of the year. Here's semi-annually, every 6 months. Here's quarterly, every 3 months. Here's monthly, every month. Here's daily. And then here's continuous. This is that letter E. This is the absolute maximum it could ever be. So you can see if you're only holding this for a year, and if it were paid annually, it would be $1,100, and if it were continuously, it'd be $1,105.17. So it's not a huge difference, and his question was specifically between quarterly and monthly. So you're talking about $1,103.81 versus $1,104.71 at the end of the year. What about after 5 years? Again, $1610.51 if it's paid annually, and continuously is $1648.72. We're starting to see a little difference, but nothing massive. Again, if we look at just the difference between quarterly and monthly, $1638.62 and $1645.31. Not a huge difference. If we go for 10 years, now we're talking about $2593.74 versus $2718.28. Starting to show, and that's because we're letting that compounding force work. Time is the key. Now, it's going to work even better if we have a higher interest rate, but for any given interest rate, it's always about time. Remember in that formula, that was the exponent. That's where that exponential growth is coming from. It's always about time. What about after 20 years? At 10%, if the bank, let's call it, pays annually, it's $67.27 versus continuously is $73.89. So now we're starting to see a difference. And that's where these percentage change columns, what they're showing. So here we're looking at 70.39 compared to 67.27 is an increase of a little over 4.5%. But down here we're comparing 73.89 to annual. Look at that. Now it's about a 10% increase. So yes, If you are talking about very long holding periods, which most people are for a 401k, it can make a very big difference the sooner you get that money into the account. But even here, if we look at between 4 and 12, compounded quarterly and monthly, 7209, 7328, it's not really a massive difference between those two. Now, if interest rates are a lot higher, just for fun, let's go to 20%. Now you're going to see some very large differences. Look at this. If the bank pays annually a little over 38,000 versus almost 55,000 if it's paid continuously. Now it's going to make massive differences. But back to our drip plans. What do most stocks pay? 1%, 2%? Let's give them the benefit of the doubt. We'll say it pays a 2% dividend annually. And even after 20 years, it's just not a massive difference. You're talking about $14.85 and change if it were paid annually versus $14.91.82. If you want to compare compounded quarterly to monthly, you're talking about basically $1, $14.90.34, $14.91.33. Not a huge difference. And the reason is once you start getting past, especially 4 compounded quarterly, it starts to hit that wall pretty quickly. Not a real terribly big difference going from 4 to 12 to 360 or continuous, unless you are talking about very high interest rates for very long periods of time. So if you are in a drip plan, I wouldn't get too worried about if one pays monthly versus one pays quarterly and thinking that it's going to make a huge difference. So I hope that helps you to understand what compounding is, the power of compounding, where it comes from, and if it's going to make a difference for your dividend reinvestment plans. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.